Ekonomi Malaysia sejak tahun 1970 telah mengalami pasang surut beberapa kali disebabkan oleh pelbagai faktor yang sebahagian besarnya berpunca daripada faktor luaran memandangkan polisi keterbukaan ekonomi Malaysia. Malaysia pertama kali mengalami krisis ekonomi pada tahun 1973 berikutan kenaikan harga minyak yang lebih dikenali sebagai kejutan minyak pertama akibat peperangan antara Mesir dan Israel. Namun, krisis ekonomi yang paling diingati dalam sejarah Malaysia dan juga ASEAN adalah pada tahun 1997 dan 1998. Pasti ramai yang tahu bahawa Malaysia antara negara yang telah berjaya dalam menangani krisis hebat ini. Namun, tidak ramai yang tahu bagaimana ia bermula. Jadi, mari kita lihat sejarah yang telah membawa perhatian dunia terhadap Malaysia.
Hi, I am Nur Najwa binti Jamhari.
Hi, my name is Noorani Sulina binti Azmain.
Hi, my name is Syahrina binti Muhammad Fadli.
Hi, my name is Siti Nachaya binti Yusof.
Hi, my name is Nabila Husna binti Muhammad Kamal.
Hi, I am Nurul Zulaika binti Muhammad Razali.
The Asian financial crisis is a crisis caused by the collapse of the currency exchange rate and hot money bubble. The financial crisis heavily damaged currency values, stock markets and other assets prices in many East and Southeast Asian countries. For example, Indonesia, South Korea, Thailand, Hong Kong, Laos, Philippines and Malaysia also were affected by the crisis. The Asian financial crisis in 1997 and 1998 is deemed as one of the worst economic crises Malaysia has ever faced. Its main cause was the wholesale adoption of financial deregulation in both capital accounts and banking sector. In July 1997, within days of the Thai baht devaluation, the Malaysian ringgit was heavily traded by speculators. RM has for several years been relatively stable at around 2.4 ringgit to the US dollar, but it depreciated to 2.8, then to 3.00 and reached a low point of 4.88 on 7 January 1998. But how can this issue happen? This is due to a drastic decline that was significantly caused by the speculation as speculators sold the ringgit short. There were at least two mechanisms for this short selling. The first one is the speculator sold the ringgit in the forward market at the current exchange rate with a view to delivering the ringgit at a future date. Or the second one is the speculator borrowed ringgit to sell it presently and hold dollars. These actions contributed to the weakening of the ringgit as the demand for the US dollar increased. When the ringgit depreciated, the speculators could reap the profit. But how they can gain the profit? Okay, so when we look back at the two mechanisms, from the first one, they can gain profit when the speculators delivers the agreed ringgit amount at the previous rate and obtains the agreed dollar amount, which in turn can now be exchanged for greater amounts of ringgit since the ringgit has depreciated. And the second one, when the time comes for the speculator to repay his ringgit's denominated loan at the previous exchange rate, he needs to use only a part of the dollars he has accumulated, and the balance of the dollars is his profit. So, the Prime Minister Dr. Mahathir Mohamad imposed strict capital controls and introduced a 3.80 peg against the US dollar. Also, Malaysia also stopped the overseas trade in ringgit currency and other ringgit assets, therefore making offshore use of the ringgit invalid, restricting the amount of currency and investment that residents can take abroad, and also imposed for foreign portfolio funds a minimum 1-year stay period, which since has been converted to an exit tax. Besides that, the property bubble also burst and the crash was accompanied by the massive capital outflows as the confidence in the Malaysian economy became increasingly shaky. As a result, the banking system began to experience increasing non-performing loans, which according to Bank Negara data, rose from about a modest 2.18% in June 1997 to 4.08% in December 1997, and then to a high of 11.45% in July 1998. Furthermore, private sector estimates for NPL ratios at the time were much higher than the official figures suggested, as many companies has begun to roll over debt as part of their survival strategy. Meanwhile, the increase in NPLs in the banking and financial sector was reflected in a sharp downturn in borrowing and financing, bringing about tight liquidity conditions.
Most Asian countries maintain an exchange rate match to the US dollar for many years. This provided a sense of security to the business security. The stronger the Asian currency partly explained the decline in export of Asian in 1996, which grew by only 8% compared with 14% in 1995. The decline in export could also be partly explained by the loss of the Asian countries' export competitiveness, particularly in electrical goods, which constitute more than half of Asian export. The decrease in export worsened the trade deficit, increasing the current account deficit. The rapid economic expansion in the region had increased the demand for foreign borrowing. In the environment of stable exchange rate, the high interest rates in Asian countries, therefore foreign capital inflow increased. The increase in the availability of capital enabled the expansion of loans for private spending, particularly in real estate and motor cars, creating a price bubble for these sectors. When the bubble collapsed, the entire financial system was severely affected. In addition, expectation of a Japanese recovery in early May 1997 led to sharp appreciations of the yen and a sudden rise in Japanese short-term interest rate. Investors started to withdraw their funds from Southeast Asian market to take advantage of the higher interest rate in Japan. The withdrawal of short-term credit placed considerable pressure on the reserve and exchange rate, making the baht vulnerable. The Bank of Thailand virtually lost all its reserve while attempting to defend the baht, and was forced to float their currency on 2nd July 1997. By the end of that month, Thailand had requested assistance from the International Monetary Fund (IMF). By then, the contagion effect had spread to the Philippines, Malaysia and Indonesia, which then floated their exchange rates. At its most basic, the debate over the causes of the crisis centers on whether the cause was first the weakness in the fundamentals of the Asian economies, or secondly the risk factor associated with open capital and financial market.
So, I will explain about the effect of the financial crisis in Malaysia. So, we start first with the trade balance. Currency depreciation will typically assist to enhance the current account balance. With a cheaper ringgit, export rise faster than import, reducing the current account deficits. For importer, an exchange rate of the 4 ringgit to $1 USD means they must now pay approximately 37.5% more than they did before to the July 1997, when the exchange rate was the only 2 ringgit 50 cents. The decline of the ringgit has the most exposed of the Malaysia goods, according to the exporter. In the 1997, the value of the export increased by the 12.4% in ringgit term, but just 0.5% in USD terms as compared to the previous years. Alright, so we move to the primary commodities. In terms of the primary commodities, the ringgit decline had a minimal influence on the rubber price because they are listed in the ringgit. Rubber price increased slightly from the 279.3 per kilo in June 1997 to 287.3 in April 1998 due to the exporter adjusting upward because the increase would be a little in the US currency term. On other hand, palm oil price have have arisen significant from the 1,250 per ton in June 1997 to 2,366 per ton because of the high global demand of the vegetables oil and Indonesian export restriction on the palm oil since January 1998. The decline of the ringgit has a different impact on the rubber products. Dry rubber based on industries such as rubber dryers and the footwear have suffered because of their high import contents and focus on the local market. So, we move to the next impact is a declining trend in the foreign direct investment level. The Malaysia Industry Authority reported a declining trend in the foreign direct investment level from January to December 1998 as a measure by the value of the application received in the manufacturing sector and application for the investment incentive from a hotel, tourism and agriculture sector. As a result, it may be concluded that investors tried to reduce their investment to prevent the losses during the crisis. The financial had an influence on the public sector as well. The last but not least is a decline in the stock price. The Kuala Lumpur Stock Exchange Composite Index dropped by the 60% of the 1st July to 31st December 1997. Following a small recovery in the first quarter of the 1998, the index dropped to an 11 years low of the 467.55 points on 7 July 1998, with a market capitalization drop by the 66% to the 308.69 billions from the 970 billions. The movement of the KLSE stock price was influenced by a number of the factors, including exchange rate change, regional economic progress, and a sharp loss of the confidence in developing market by the foreign investor.
Before that, let me introduce about this issue first. The Malaysian Alternative Strategy consists of several aspects for the financial crisis in 1997 and 1998. The strategies were not developed all at once, however, stage by stage, as a response to the developments in the crisis since the initial policies proved inadequate. The core macroeconomic policies of interest rate, monetary policy and fiscal policy, and also financing plan were important to avoid the real economy from further deteriorating and to get faster recovery for a country. Okay, so what are the Malaysian policy response towards financial crisis? It is expansionary policy of monetary policy and fiscal policy. Before go further, let me explain what is expansionary monetary policy and what is expansionary fiscal policy. The expansionary monetary policy is applied when the economy is in a recession and also when there is a high unemployment. They aim to increase aggregate demand by cutting the interest rate and increasing the supply of money in the economy. The money supply can be increased by buying the government bonds, lowering the interest rate and the receive ratio. Okay, so for the expansionary fiscal policy is usually characterized by deficit spending when government expenditure exceeds received from taxes and other sources. In practice, deficit spending tends to result from a combination of tax cut and higher spending. There are two stages of financial crisis, which are initial stage and middle stage. During the initial stage of the crisis, the combination of a tight monetary policy, fiscal restraint, and the financial sector restructuring measure brought negative result, which is they apply contractionary policy at that time. Next, middle stage. In the beginning mid of 1998, the policy focus shifted towards preventing any further contraction of the economy, reactivating economic growth, and ensuring the continuation of a socio-economic projects so that the living standard, especially the poor and lower income group, to not adversely affected. The alternative strategies were also taken to strengthen the financial system. The government also is our monetary and fiscal policy. Now, we go to the best part, where we know the policies that we use or apply during financial crisis. For the monetary policy, central bank reduced the interest rate from 10% to 9.5%, also cut statutory reserve requirement ratio, which is the funds that banks are required to maintain balance with the central bank, from 6% to 5% in order to inject liquidity into the banking system. From here, you can see the illustration curve for expansionary monetary policy. Last but not least, fiscal policy. The government took alternative to boost growth through fiscal stimulus package and also changed the fiscal stance from surplus budget to deficit budget. Moreover, the government has increased budget allocation in 1998 by 7 billion ringgit, especially to finance development project. Referred to the expansionary measure, it resulted in the overall public sector account registering a manageable deficit of 1.8% of GNP in 1998. Thus, it increased to 3.2% in 1999 and 5.5% in 2001. This package focused on selected projects with strong linkages to the economy by maximum stimulus to economic growth, minimal leakage of imports while meeting socio-economic objectives, however, not give pressure on prices. It's given priority on projects of housing, education, healthcare, rural development, and infrastructure. Now, you can see three curves of a different situation that happens in the expansionary fiscal policy.
Recovery Action Financial Crisis in Malaysia 1997. First, reduction in interest rate. A key component of the alternate plan was bringing down the interest rate. The 3 months intervention rate of the central bank and the imposition of capital control have resulted in falling interest rate from 11% at the end of July 1998 to 3% by December 1999. Second, stabilizing the currency. The currency rate of 3 ringgit and 80 cents to $1 about the rate at the time was chosen. Then in September 1998, the Prime Minister announced the adoption of a fixed exchange rate system. The central bank utilized the rate to convert dollars with ringgit for banking institutions and other approved financial institutions, and in return must use the rate in its currency interaction with the public. Without being bound by worries of the currency's collapse in value, it enabled the government to pursue monetary and fiscal policy based on its own merits and reduce the possibility for speculation. Then, selective capital control. On 1st September 1998, certain restrictions were introduced to control the outflow of money. There are several measures for foreigners and foreign funds include the following. First, the domestic credit facilities were no longer allowed for non-resident corresponding banks and non-resident stockbrokers. Second, investment by residents in any form abroad and non-trade guarantee payment required the approval. Other than that, residents require prior approval to make payments to non-residents for purpose of investing abroad for a amount exceeding 10,000 ringgit, equivalent in foreign exchange. Stock market measure and closure of overseas trade Asian securities. From 1st September 1998, the KLSE introduced new measures. A major aim of the measure was to prevent speculation or manipulation of KLSE share price and transaction from outside the country and to prevent the outflow of capital through the sales of Malaysian shares outside the country. Last but not least, restructuring the financial system and corporate debts. As public confidence endured, there was a need to restore confidence and prevent a run on the banks. Measures were taken to deal with these problems. Firstly, through a government guarantee of deposits and decision not to close down troubled institutions. Secondly, Dana Harta, an asset management company to manage non-performing loans. Next, Dana Modal, a special agency to recapitalize financial institutions, and Corporate Debt Restructuring Commits (ERC), a commit to structure corporate debts. These three agencies work together to try to resolve the interrelated problem in a coordinated way.
Okay, so what are the lessons learned from this crisis? One of the great lessons of the crisis is the critical importance for developing countries to properly manage the interface between global development and national policy, especially in a pan-nation financial system and policy. In a rapidly globalization world, developing countries face tremendous pressure which come from developed countries, international agencies, and transactional companies to totally open up their economies. In some cases and under certain conditions, liberalization can play and has played a positive role in development. Secondly, a capital control should be seen as a normal, acceptable and indivisible component of the array of policy options available to promote development. The causes and consequences of the crisis differ across countries and cannot be explained in terms of a single set of factors. The experience suggests that we must see the countries as different strengths, and proposal on how to tackle the crisis must correspondingly be different. Strong fundamentals by themselves provide insufficient protection against financial crisis. Thirdly, a large foreign debt put a country in a situation of considerable risk, especially when a country has liberalized and its currency is fully convertible and thus subject to speculation. In particular, having too much short-term debt can be dangerous, as it has to be repaid within a short period of months or a year, thus requiring the country to have large enough reserve as that period to be able to service the debt. It is thus important to watch the relation level of debt and debt servicing not only to export earnings but also to the level of foreign reserve. Lastly, at the macro policy level, a very critical lesson from the crisis is that government has to pay great attention to external debt management. The government has to take great care to limit the country's foreign debt. It was the rapid build-up of the external debt than anything else that led to the crisis in Thailand, Indonesia, South Korea, and Malaysia. Developing countries should not build up a large foreign debt, whether public or private debt, even if they have relatively large export earnings.